What is monetary policy and economics? Have you ever wondered how a country manages its money supply and influences its economy? Let's break down the concept of monetary policy in simple terms. Monetary policy is an economic strategy used mainly by a nation's central bank. Its primary goal is to control the money supply and impact key areas like inflation, unemployment, and overall economic growth. At the heart of monetary policy is the aim to maintain price stability and support full employment. These two goals are often referred to as the dual mandate of many central banks. By managing inflation, monetary policy helps to keep the purchasing power of money intact. When it comes to employment, it plays a role in ensuring that people have jobs, contributing to a healthy economy. There are two main types of monetary policy: expansionary and contractionary. Expansionary monetary policy is used when the economy is slowing down. It increases the money supply and lowers interest rates. This encourages borrowing and spending, which can help reduce unemployment. On the other hand, contractionary monetary policy is applied when inflation is high. This approach reduces the money supply and raises interest rates. The aim here is to slow down economic activity and decrease demand, which can lead to higher unemployment in the short term. Central banks have several tools at their disposal to implement monetary policy. One of the most common is open market operations. This involves buying or selling government securities to adjust the money supply. Another tool is interest rate adjustments. By changing the policy interest rate, such as the federal funds rate in the United States, central banks can influence borrowing costs. Reserve requirements are also significant. This refers to the amount of reserves that banks must hold, which affects their lending capacity. Additionally, the discount rate is the interest rate charged to commercial banks for borrowing from the central bank. Through these tools, monetary policy impacts aggregate demand, which is the total demand for goods and services in the economy. For example, when interest rates are lowered, borrowing becomes cheaper. This encourages businesses to invest and consumers to spend, leading to increased economic output and reduced unemployment. It is important to note that monetary policy is distinct from fiscal policy. While fiscal policy involves government spending and taxation, monetary policy is typically managed by an independent central bank. This separation helps to avoid political influence and maintain economic stability. In practical terms, monetary policy plays a vital role in stabilizing business cycles. It helps to smooth out periods of rapid growth or recession, promoting sustainable economic growth and ensuring the health of the financial system. Understanding monetary policy is essential for grasping how economies function and respond to various challenges.